I've been asked to do this because I'm an Australian that's just recently returned from 21 years overseas, and therefore I must know something about sovereign wealth funds. We have done quite a bit of work with them, so I have had a little bit of experience with sovereign wealth funds around the world, and what I thought I might do this morning is share some of that. When Ray and I discussed the session, we thought it would be good to try and understand a little bit of a definition of what sovereign wealth funds are, and perhaps what are not, where they come from and why they've grown so much, and then to understand some of the concerns that are recently surrounding sovereign wealth funds, and also perhaps some of the mitigants to those concerns. And then also a little bit about what they do from an investment sense, because I guess the people in this room are all investors in one form or another. Sovereign wealth funds, through their rapid rise, have provoked significant degrees of debate and suspicion. It's partly because of the rapid rise in the assets under management, but also, because of the emergence of new players in the investing field in the sovereign wealth area, particularly players such as Russia or Libya, who have substantial assets they're looking to deploy. In terms of definition, I think the simplest definition of a sovereign wealth fund is a pool of capital that is owned and controlled by government. They're generally unregulated, except by their own charter, and have varying degrees of opaqueness under which they operate. They are, however, not new. The French would argue that sovereign wealth funds started in 1816 with Caisse de dépôt. It's interesting because the French are one of the most strident critics of sovereign wealth today. But I think it's fair to say that sovereign wealth funds in their current form, in a modern form, really began with the KIA in 1953. But there are a lot of other examples that have been around since the 50s. Ho Ching of Temasek, the CEO of Temasek, describes Temasek not, however, as a sovereign wealth fund. She describes it in its origin as a sovereign poverty fund, in that it began when Singapore, and Temasek in particular, had very small assets. But clearly they've grown, and there's debate around the definition. There have been a lot of discussions on whether CalPERS, for example, is a sovereign wealth fund. We think not, and we think the fundamental difference between a CalPERS and some of the others is that the assets and the distribution of those assets, in the case of CalPERS, are owned by the participants, not government. And as I said at the beginning, our definition of sovereign wealth is when the assets and the distribution are controlled and owned by government. Sovereign wealth funds can generally be classified into two categories: petrodollar funds, or more broadly, commodity-funded sovereign wealth funds, or funds that come from, in particular, Asian FX reserves. Of course, there are others. There are others such as contingent pension reserve funds, such as the Future Fund here in Australia. But really, I think if you look at the bulk of the assets, they come from one of those two areas. What is on this chart is really just an example of the flow of capital. Historically, capital has flowed from the core to the periphery, from the developed world to the developing world. Today, capital is flowing from the periphery to the core, from the developing to the developed. This may be causing the developed world to be a little uncomfortable. And what this chart shows is on the, I guess on your left, capital flowing from the developed to the developing, $183 billion last year, versus capital now flowing from the developing world into the Western world, which for the first time has exceeded the assets flowing the other way. So this may be making the Western world a little uncomfortable. And when you start to look at some of the comments coming out of governments, particularly in Europe, but in other parts of the world, you can see that discomfort reflected. This reflects, amongst other things, the rise in the oil price. It reflects, amongst other things, the higher savings rates that are being achieved in the developing world. Emerging market savings rates, gross national savings rates, have increased by 10% to 33% over the past few years, in a time where savings rates in the Western world have declined. The first major source of funding for sovereign wealth funds are petrodollars. The simple reality, as you all know, is the oil price has tripled over recent years, leaving significant wealth in the hands of oil exporting nations. In Russia, for example, it's estimated that 85% of the windfall that comes from the oil price is directed into government hands. So that's 85% of the price of oil above $27 a barrel, which is their marginal rate, goes into government hands. And clearly, that has led to very significant flows of capital. This is just a chart which shows some of the larger pools of capital that are really petrodollar related. Clearly, the Middle East and Norway, who began to invest their excess oil-related cash flows in the 50s. But new players here include Russia, $160 billion in the Stabilisation Fund, and even in Libya, where we've been doing a little bit of work, the LIA have over $40 billion today. Typically, these funds started as stabilisation funds, designed to help governments to accumulate assets in the time of high commodity prices or high oil prices, and then to use those assets or the revenue from them to help stabilise their fiscal position in times of weaker oil prices. Over time, these funds have morphed into what would be more intergenerational wealth transfer funds, so trying to protect the wealth from one generation and pass it down to the next. This is probably best illustrated. This is just another of the same. This is probably best illustrated not by an oil fund, however, but by the Kiribati Reserve Equalisation Fund, Revenue Equalisation Reserve Fund, which was established in 1954 to protect the future generations of the island of Kiribati from the depletion of phosphate reserves. This fund, $600 million, is a lifeline for Kiribati today. Many of the newer sovereign wealth funds and the older, including Norway and others like that, have this as a legitimate objective. In fact, in Norway, all legislation that goes through Parliament has to take into account the rights of future generations. This is really important when we start to discuss the governance structure around sovereign wealth funds. As one finance minister we were meeting said to us, the purpose of the governance structure, the purpose of this fund and how we govern this fund is really to protect the assets in the fund for the benefit of future generations from people like me, so to protect them from governments today who may use them unwisely. Another benefit of establishing a sovereign wealth fund in a commodity-producing nation is to protect the economy from what is called Dutch disease by transferring assets overseas. Dutch disease is simply the bidding up of domestic asset and FX prices to the point where the non-oil commodity part of the economy becomes permanently impaired. So that's one source. Commodities, most importantly petrodollars, but you could look at phosphate and others as well, any commodity-based pool of capital. The second primary source of capital for sovereign wealth funds is Asian FX reserves. Booming trade surpluses fueled by undervalued currencies and high savings rate have led to dramatic increases in reserves. Asian governments post the Asia crisis have been happy to allow these reserves to build. What this chart shows is some of the larger pools of reserves in Asia, China being at the top. China's reserves, for those that can't see it, have increased in this period from $170 billion to about $1.3 trillion today. These have begun to be deployed either through the SAFE Investment Corporation, the State Administration of Foreign Exchange Investment Corporation, or through the more recently formed CIC, China Investment Corporation. Japan's reserves have increased to about $1 trillion today. They've not been deployed yet, although there is talk in Japan of establishing a sovereign wealth fund. Taiwan's have increased but not been deployed. I turned mine off. Korea's have increased substantially, almost from zero at the time of the Asia crisis to over $200 billion today. Korea's reserves have begun to be deployed through the formation of the KIC, which was funded amongst much contention in Korea by taking $20 billion of the reserves and forming a new investment corporation. India's reserves have increased to over $200 billion, but not been deployed. And then in Singapore, as we know, Singapore established their sovereign poverty fund in the 50s and GIC at the same time, well-established sovereign wealth funds. So the reason that a lot of the countries are focused on doing this, on moving from reserves to investment portfolios, is that their excess reserves to that which they need for intervention or for interest cover have become very large amounts of money. And there is an opportunity cost to having this invested for liquidity and having this invested predominantly in US Treasuries, which are low yielding. So they've begun to look at more return generation. We've talked about where the reserves have come from and how they're being deployed, but I think there's clearly scope for growth, even if there is no further growth in reserves in Asia, as a lot of those countries that we listed before have not yet begun to deploy their reserves into investment portfolios. And so there's obviously potential for that to happen and new sovereign wealth funds to be formed. So in essence, sovereign wealth funds are here. They're large, they're already significant. We expect them to continue to grow. They've grown historically at about a 20% compound annual growth rate, much faster than the pension market over the last few years, the last 6 years. They've grown at a growth rate more in line with the growth of the hedge fund industry, and similar size as well. We expect sovereign wealth funds to grow to in excess of between 10 and 12 trillion dollars over the next 10 years. It's important to note when you look at their market impact, however, that they are generally unlevered. So if you take $1 billion into the hedge fund industry, it will have a bigger market impact than $1 billion into the sovereign wealth funds, because hedge funds tend to lever and sovereign wealth funds don't lever. For what purpose have they been created? We've talked a little bit about this already. Initially, stabilisation funds to smooth fiscal fluctuations in the economy, to avoid Dutch disease, and to help the transition from dependence on just one commodity. And more recently, to also serve as a vehicle for intergenerational wealth transfer. In regard to particularly the FX reserves, to generate higher returns than have been generated traditionally through the reserve portfolios. And then I would add to that, to provide for the government pension deficits without actually having direct liabilities. How are they investing? It's actually very difficult to generalise, because all of the sovereign wealth funds around the world are at different stages of their development. The Russian Stabilisation Fund is still invested today by the Russian central bank in G5 government bonds, but they are looking at broadening that significantly. Contrast that with Temasek, who's been investing in private equity since 1974. If you had to characterise, however, I would say that most sovereign wealth funds are taking a sophisticated, clean sheet of paper approach to their investing. They're carefully examining their own objectives and structure and its implications for their investment portfolios. In terms of structure, they only have one client, and probably a number of investment managers in this room would think of the benefits of that. They have no calls on their cash flows. They have no distribution needs, at least certainly in the short term. They have no liabilities. They, in many cases, have stable inflows, obviously dependent in some cases on reserve accumulation or the oil price, but given the status quo, they have stable inflows. And very importantly, they have a very long-term investment horizon, in some ways similar to those of a foundation. What are their objectives? Many sovereign wealth funds set the objectives for the internal management team as a real return target, a CPI plus type of target. They don't manage to peer group, they manage to their own objectives. The first part of that is modelling their objectives to determine which of the risks are hedgeable and which are not. For example, if they're managing against a total return, a CPI plus benchmark, they may look at hedging as much of the inflation risk they can by going long CPI-linked bonds, and then producing a return-generating portfolio to produce that alpha, that return above inflation. In terms of implementation, there are a number of themes, and this clearly won't be conclusive. They are looking at taking advantage of the return premium that comes from illiquidity. This is reflected through their investments in private equity in many cases. They don't need liquidity, like a lot of the pension funds in this room, don't need liquidity, certainly not in the short term. So they want to capture those illiquidity premiums. Some of them, notably the CIC in China, have gone one step further and actually invested or partnered with a private equity firm, Blackstone. They are looking at increasing the share of alpha in their portfolios through alternative investments, I'm sure a theme that's been talked about at this conference already. And they are taking advantage of their size through investing directly in taking equity stakes in companies. And we've seen this obviously quite a bit in recent months in taking stakes in particularly US and European financial institutions. KIC's investment in Merrill would be one example of that. They're also thinking very carefully about managing their costs of implementation. They are government entities. In the end, when you look at their email addresses, they often have a .gov at the end. And they are managing their costs. They're managing their costs through using third-party providers such as transition managers, asset managers. They're looking at passive investing. And so they are very much focused on the cost side of the balance sheet as well. They're also looking at how they get the most from their counterparty relationships, whether it be things like futures clearing, rebalancing, training. They're looking for managers to align, taking advantage of their size again, and looking for managers to do different things than they've ever done before. Looking for managers to align their interests with those of the actual fund. And that may be in the form of very long-term performance fee structures, or it may be in the having a real partnership with their underlying third-party providers. They're doing a lot of the things that foundations do. They're doing a lot of the things that pension funds could or should do. I guess their advantage is largely they're starting with a clean sheet of paper, and in a difficult market, they're starting with very large amounts of cash. Just in terms of some of the direct investments, the characteristics of their direct investments, they have been taking direct stakes in less liquid investments. They're helping to recapitalize the US and the European banking system. 53% of their investments, large deals over the last couple of years, have been in financials. They are, however, investing in a responsible way, we think, and trying to address some of the concerns that have been raised, which I'll talk about a little bit later, around foreign government-controlled entities taking stakes in strategic industries. They're addressing these through, as I said, friendly investments, not taking board seats, etc. There have been a number of positives with regard to recent sovereign wealth investments. There have been a lot of criticisms as well. The positives are they can move large amounts of capital relatively quickly. Some countries, France, President Sarkozy had called them a force for instability. We'd probably take the other side of that trade and say that they're a force for stability. It's important to recognise that providing stability to financial markets is not one of their agenda items. It's not one of their objectives. What is required from them is they behave responsibly, and I think they are. But in that they have been cashed up into this recent financial turmoil, it's given them the ability to be buyers on dips, and that's certainly what we've seen, both in the secondary market, but also a provider of stability through taking significant stakes in financial institutions. Initially loss-making, obviously, in many, many cases, but they all have very long investment horizons, and we'll see whether they can continue, given that some of them are subject to criticism in their own countries for some of those stakes. In terms of the concerns, I think President Sarkozy's is probably reflective of, although quite aggressive, quite reflective of some of the concerns. In the face of the increasing power of speculative funds, which are extremely aggressive, and of sovereign wealth funds, which do not obey economic logic, there's no reason for France not to react. France must protect its companies. We don't think we've seen any evidence of sovereign wealth funds behaving badly, behaving in a speculative way. We don't think that we certainly haven't seen evidence of them not having an economic logic to their investments. But there are criticisms of sovereign wealth funds, and they can be addressed. They're addressing them already, as I said, through friendly investments without taking board seats. There are other concerns as well. I think they're reflective of the rapid rise in diversity of the funds, the countries and governments that are involved, and the size. There are concerns over transparency of what they do. There are concerns over taking stakes in strategic industries. There are concerns as new organisations around their compliance structure and their operational risk. But I think the primary concern is the concern that Sarkozy reflects, which is effectively having a geopolitical agenda in their investing. The premise of capital markets is that capital flows freely in search of investment opportunities that yield the best risk-adjusted returns. We've seen no evidence that sovereign wealth funds don't follow that premise. Further mitigation, though, of some of the concerns that are coming out of governments may be addressed through the governance structure of sovereign wealth funds and the transparency. Although, as Badr Al-Sayed from the KIA has said, you shouldn't single out sovereign wealth funds. Legitimately, you could talk about hedge funds, private equity funds, or even pension funds when looking at transparency. Sovereign wealth funds, however, are a little bit different in that they are foreign government, they're government owned, and therefore, if they're investing cross-border, they're foreign government owned. And therefore, the issue around governance and transparency is more important. Some have come out very deliberately to counter any criticisms. Abu Dhabi has said the Emirate has never and will never use its investment portfolio as a foreign policy tool. Transparency can help the sovereign wealth fund as well, though. The KIC in Korea has recently come into some pretty significant criticism. The front page of the Korea Times 2 weeks ago called them young and stupid, which is pretty significant criticism, for their investments directly in financial institutions. Whereas other sovereign wealth funds that operate with a high degree of transparency, such as New Zealand, effectively could say to their constituents and potential critics, all of the information by which we make our decisions is up on the web. It's all available for you to criticise with the benefit of foresight. You've got the information set that we have when we make investment decisions. If you've got better ideas, let us know, but don't come back with the benefit of hindsight. Others have said, however, that transparency will impact their ability to invest. We disagree with that. When you look at this chart, which is a measure of transparency in sovereign wealth funds on the x-axis and the size, investment strategy of the sovereign wealth funds on the other, between passive and strategic. But the important other thing is the size of the dot. As you can see from this, Norway on the far right is one of the largest funds. It's also one of the most transparent in the world. When you look at the annual or quarterly report of the Norwegian fund, it is incredible the detail that you can get from there. They talk about their asset allocation, they talk about their deviations from benchmark, they talk about the managers they select, where they go direct, they have audited reports, etc. They have a foreign CIO for equities, by way of example. They talk about their compensation structure. So I don't think transparency, and they've had good returns, so I don't think transparency is necessarily in conflict with the ability to invest. Been a lot of calls for transparency and a lot of calls for some sort of code of conduct for sovereign wealth funds. I was going to talk about some of the things that we've talked to people about in terms of a voluntary code of conduct, but actually last Friday the IMF came to agreement with some of the sovereign wealth funds around a voluntary code of conduct under which they'll operate. I think that as they go through this, we shouldn't demonise funds that don't sign up. We should reward funds that do. And the ability to get this voluntary code of conduct, I think, is pretty impressive, because in the run-up to this, there has been comments from some of the sovereign wealth funds that they would never sign up to a voluntary code of conduct, particularly when hedge funds, private equity funds and other pools of capital haven't been forced to do that. But it was announced on Friday that they will do that, and they'll release the details of that in October, I think. I think when they start to look at the code of conduct, the type of things they will look at will be some of the things that underlie this chart. What this chart is, Linneberg Manduel, a sovereign wealth advisory organisation out of California, actually. And what this chart is based on their scoring system, which of the sovereign wealth funds in the world are most transparent. For those that can see, Norway would be right up there. And the factors, important to note, however, when you look at the factors they're looking at, there are no negative scores. So if you don't score positively on one, you don't get a negative score. So really, I think sovereign wealth funds should be shooting for a high score out of 10 here. The type of things that underlie this are, I think, the things that will come out in the voluntary code of conduct. And I think there will be things like the sovereign wealth fund must be transparent about their history and their structure, produce audited annual reports, produce some level of detail around their investments, produce published returns, investment policy guidelines and ethical standards, have a defined investment strategy, identify where they use external managers, have a website, and have contact information. I would imagine the voluntary code of conduct that hopefully sovereign wealth funds will sign up to, as sponsored by the IMF, will have a lot of those things in it. So I'm going to conclude, just say that sovereign wealth funds are large. They're going to continue to grow, we believe, 10 to 12 billion over the next few years. They are legitimate in their purpose, but the landscape varies. But in general, they're innovative, and I think they're leading investment thought. I think a lot of the political rhetoric is misplaced. We've seen no evidence of, actual evidence of bad behaviour, but will be mitigated further by a voluntary code of conduct. Thanks very much.